Hello everyone, welcome back to our channel and welcome back to this video. In today's video, we wanted to talk to you about Anthropic's SPV problem and why the pre-IPO hype is fueling a shadow market in the AI shares. Let's talk about the hot AI valuations, the unsanctioned deal structures, and the risk retail investors need to understand. So, in summary, what is happening is that as Anthropic approaches a potential IPO at a reported $350 billion valuation, demand for its pre-IPO shares has surged, and with it a proliferation of unsanctioned special purpose vehicles that the company has been trying to ban since last summer. These multi-layer SPV structures carry steep fees, for example 10% management fee plus 10% carry in some cases. They lack transparency and may not even deliver actual company shares. For everyday investors who are caught up in AI FOMO, the risks are significant, from voided transactions to outright fraud. Through this analysis, we're going to try and unpack the mechanics, the market dynamics, and what the investors should watch out for. Let's first try and understand as to what are SPVs and why do they matter. SPVs are special purpose vehicles and they are pooled investment structures that allow multiple investors to combine capital for a single deal. In the private markets, they serve a legitimate function. They give smaller investors access to high-profile rounds that would otherwise require multi-million-dollar minimums. Now, the trouble starts when the SPVs operate without any target company's knowledge or permission. Most high-growth startups prefer direct investor relationships for good reason. They want visibility into their cap table, control over who holds equity, and the ability to manage governance. Anthropic did permit SPVs in the earlier funding round, but as its bargaining power grew, it moved to ban them starting last summer, a restriction it maintained in its latest $30 billion raise. Next, let's try and understand the multi-layer SPV problem. What makes the current situation especially concerning is the rise of multi-layer SPVs, structures wherein investors don't buy shares in Anthropic directly, but instead purchase another investor's share through a secondary wrapper. This adds layers of intermediation, opacity, and cost. In a recent pitch that was reviewed by Business Insider, offered Anthropic shares at $350 billion valuation, matching what marquee firms like TE Shaw and Founders Fund were offered, but with a 10% management fee on top of 10% carry. Now, to put this in context, traditional venture capital funds typically charge 2% management fee and a 20% carry. And they justify those fees by sourcing and doing the diligence work involved in building a portfolio. However, an SPV wrapping a single known asset at 5 times the standard management fee is a very different value proposition altogether. But there has to be a reason as to why this structure exists, and let's try and understand that. Now, the multi-layer design is not accidental. By routing the investment through a secondary entity, sponsors can obscure the transaction from Anthropic's compliance team. The company cannot enforce its SPV ban if it cannot see the transfer. This is precisely the dynamic that the market participants have described as deceptive. The layering exists to circumvent company rules, not to serve investor interests. Next, let's try and understand the catalyst behind these SPVs, and that is the IPO. The surge in the unsanctioned SPVs is directly linked to Anthropic's widely anticipated IPO. Pre-IPO demand creates a powerful cocktail of urgency as well as scarcity. Investors, particularly the non-institutional ones, want exposure before the shares become publicly available and are willing to accept terms that they might not fully understand to secure a position. This fear of missing out driven demand is where the real risk lies. The retail investors drawn to the AI narrative may not appreciate that they are paying egregious fees buying into a structure that the company has explicitly banned, or that the shares might never materialize if the transaction is voided. The consequences range from financial loss to a potential involvement in deals that carry legal risk.